You know what? We just finished talking with Shannon Keatley of the Alliance Group. We found out how to not have your money fall through the cracks when you're selling your real estate. And then we talked about with Bill Exeter about how to reduce or eliminate taxation when you're transitioning out your real estate. Now, one of the things I do want to say, there's many other strategies you could utilize, whether it be conservation easements, there's oil and gas contracts, there's deferred sales trusts, there's a lot of them. You want to take a look at those. But one of the big things that people do after they figured out the taxes is, how do I create the income that I need to derive from the proceeds of the sale? That's why we have Don Meredith. He's the president of Tactical Income. Don, welcome to the show. Thanks for being here.
Good to see you, Steve. Thanks for having me.
Now, one of the biggest things when people have, when they sell their real estate, they've taken care of the taxes, now what they're looking to do is fund grandkids' college, their bucket list tours, trips, travel. And you know what? Maybe it's just in case they have that long-term care need, they have the income that they need to do that. But the reality is, hey, they're concerned about those investments. They're uneasy about them, and they need to get some education. That's why you're here. Again, thanks for being here. Tell us about some of the options that people have when they do a 1031 exchange. What are the options that they have other than going to another real estate property?
Well, that's exactly it, Steve, is that not too many years ago, if you accumulated income real estate and you now wanted to exit it, what do? You just have one option. You pay capital gains, or you sell a property and buy another property, which doesn't really alleviate that issue. You're still managing, right?
Yeah.
Nowadays, the baby boomers are rapidly aging, and we see all this population with rental property, and they want to get out of it, or at least some of it. Some of it they might enjoy. Others may have had a few too many trips to Home Depot. Oh, yeah. Not so much fun anymore.
Talked about that.
So they're looking at DSTs is an exit strategy.
What's a DST?
It's a Delaware statutory trust, and it's sponsored by some of the great real estate companies in this country. And it's simply a trust that they put real estate in. It is totally acceptable by IRS standards. In 2004, the IRS created language specifically for the DST as a 1031 exchange. And the average investor, you have to be accredited, and there's accredited guidelines to follow, risk guidelines. But this is a wonderful option to consider to get
what kind of property goes? What kind of properties or real estate properties go inside a Delaware statutory trust?
Well, these are institutional grade properties, Steve. So we've seen ESPN studios in Bristol, Connecticut.
Okay.
We've seen packages of CVS, corporate leases, great tenants, long leases. We've seen big multifamily properties, 200-300 unit, and by great institutional real estate companies.
So what type of income could somebody realize out of these type of properties, or the DST?
You know, it varies, but you're looking in the 5–6% range, even a little better, and that's net to the investor. There's expenses and so forth in these DSTs, but net right now, as of this, airing, you're looking at about 6%, a little better.
Now, my understanding is those incomes are inflation adjusted. Is that correct?
That's right. That's the first year cash flow. You have all the tax advantages of real estate.
So they're going to get depreciation again?
You reset the clock on depreciation. A lot of investors out there have used up their depreciation.
Okay. Now I want to switch gears on you, and I know you brought a slide, but here's the big question I have. You know what? Some people, they don't have to pay the taxes on it. They might be living in their primary residence and they're selling it, and they're within that $500,000. Where can they invest without going into a DST, but might have a little bit more liquidity than something like that?
Well, we have to almost look through a different lens these days. We had a psychologist on the radio show the other day who said people are still suffering from PTSD.
Okay.
From 2008. And so what that means to us is people are still gun-shy about the market. And if you saw the movie The Big Short, that didn't help. You wonder, if Wall Street is totally working against you, these big hedge funds, you choose a stock or a mutual fund only to feel like they're selling it off on you as soon as you make that choice. When you turn your portfolio into income, it slows down that process. It cushions the process. It's harder for Wall Street to get on the other side of that. what I mean by that is when you buy real estate, and you can buy it as a stock, Steve, but the problem is if the stock market sells off, it starts to act less like real estate and more like a stock. So there's real estate trusts out there that you can get in the accumulation phase. They don't trade. It's illiquid, and that makes some people nervous, but it's the illiquidity that makes these a great investment. What I mean by that is if it's too liquid, it causes us to, and institutions to liquidate.
Okay.
Causes volatility. Real estate trusts, there's some great properties. You find trusts that have Boeing, Roar, great
So very
properties.
established companies that aren't going anywhere,
right?
And they're paying rent to you.
They're paying rent to the trust, which is its own corporation, and it's because it's not liquid. You know, you have to do financial planning around this. But if you take a small bit of your portfolio that's income producing in that trust, give it a job to do, let it pay a mortgage, let it pay long-term care. The more you turn your portfolio into income, the less volatility you have and the less you have to worry about the ups and downs and these big swings in the stock market. So
what you're saying is the more you turn it into income, somebody's going to have more stability with that income and therefore have less, sleep well at night, so to speak.
Well, absolutely. You know, I ran into somebody last week, they're 67 years old, and he said, hey, I lost 35% of my portfolio in January in the big downturn in the market.
In 08, yeah.
I ran into a doctor who said, I've been in cash since 08. I am just terrified of the market. Two extremes, right, Steve? So if you just start to turn that portfolio into income, add some real estate. They call this the alternative space. However, if you look at the Yale Endowment Fund, that is almost all the alternative space, only 7% in equities. What they're doing is they're getting things that are less correlated to the stock market in that endowment fund, and I recommend people do the same thing. It allows you to sleep well, Steve, and you don't have to worry about the volatility quite so much.
Thanks for joining us today, Don. It was great.